All right, here in week 9 for ACCT 2011, talking about accounting for financial instruments. So, financial instruments, there's a few things to talk about: compound and simple financial instruments. And then we have primary and secondary financial instruments. So, this is all about the categorization of financial instruments, identification of these instruments. So, these are the rights to receive and the rights to give or obligations to give certain economic benefits. So we move on in, we have accounting for financial instruments. Here, the learning objectives are really straightforward, not so much calculation, but more define and explain. So it's a very introductory sort of concept towards financial instruments. Financial instruments gets really complicated, especially when we get into derivatives and the purposes of the same things. Now, the reason we have a big emphasis on define and explain is that the same exact item could be placed under different financial statement line items depending on the nature and the operations of a company. Okay, so a trading company, a company that engages in financial instruments, may treat a derivative as a investment, as a core operation, whereas a potentially a retailer may use financial derivatives for hedging purposes. So therefore, the purpose and rationale behind the use of certain instruments would be determinant on the nature and the operations of a company. So therefore, even if it's the same exact instrument, it could be treated differently depending on the operations of the company. So firstly, definitions of financial instruments. Financial instruments are any agreement that creates a financial asset or an entity, and it also could be a financial liability or equity instrument of another entity. For example, the sale of a good by one entity to another on credit would give rise to financial assets to the seller. But on the other hand, there has to be a counterparty. It becomes a financial liability to the purchaser. So, those definitions of financial instruments here is that, okay, so here we can see a certain pattern. So cash is, if cash is at hand, that it is a right to receive cash at hand, okay? And equity and rate investment would be the right to receive dividends, okay? So these are the, okay, all financial instruments either have the right to give or the right to receive, okay? The contractual rights, then we have a contract that would give or be settled by an entity's own equity or instrument. Definitions of financial instruments: we have financial liabilities, which are contractual obligations, or financial instruments, which are equities, so non-derivative, derivative equities. So here we have definitions of financial instruments. Definition of financial, we see from the balance sheet here. Definition of financial instruments could be primary, so financial instruments. Primary financial instruments has a direct link to it, whereas derivative financial instruments derive the value from a certain underlying item. Definitions of financial instruments: simple versus compound. You could read that yourself as well. So categories of financial instrument, it is categorized by its purpose. So it's categorized by its purpose and what the intentions of the management are. So if you look at, there are three main ways to hold a financial instrument at amortized cost. So this is, for example, for bonds intended to hold to maturity and not intended to be sold. We could also be fair value through P&L. So this could be derivatives held for trading purposes. And we have fair value through OCI. So here we have the categorization. So it's the business model and classification that causes it. So here we have the example of the three different methods or three different buckets for financial instruments to be placed under: amortized cost, fair value through OCI, under comprehensive income, or fair value through profit and loss. And you could look at this chart now. So if derivatives are held for trading, then it's fair value through profit and loss. All gains or losses are immediately put into the fair value of the gains or losses. Financial instruments, initial recognition, fair value. Once again, fair value is a massive concept in this course. So what is meant by fair value? Measures of amortized cost, OCI, financial assets, measures of financial liability, hedging purposes, and that's what we have went through here in week 9 of ACCT 2011. So all the best studying, take care, and goodbye.